Ladies and gentlemen, welcome to my show, The Ultimate Market Insights. Today, there's a lot of noise around market, economics, GDP, growth. We have information coming from different sources. We have information, news coming from newspaper, news channels, Twitter, blogs, social media handles. So there's today a overload of information. With too much of information, it becomes very difficult to identify the right investments. Those investments which can help us grow rich, which can help us make profits. So, my channel is going to help you cut this clutter. I'm going to give you 5 charts which are very powerful, which will give you good insights to pick right investments and make a lot of profits. So, are you ready for that? Okay, so let me take you through the 5 charts. The first chart is about oil. Today there is a lot of noise related to oil, especially because there has been a war between Ukraine and Russia. The oil prices have gone up and it is now at $120. The oil prices have gone up because Russia is one of the largest exporter of oil, and with the crisis, the Russian export has been hit. Now the question mark is, how much is the high oil price going to impact us? Is it going to impact everyone the same way? Let's check out through this chart. Now this chart shows that a full tank of petrol, costs how much for different people of the world. So if you look at this, average Indian spends around 17% of his monthly salary to get a full tank of petrol, which is a lot of money. Now, if you look at some other country data, the USA person is spending only 1.5% to get that full tank, which is very less. So the US people are not so much affected. If you look at China, it is only 6.24%, though it's an emerging economy, but the per capita income has gone so much that it doesn't impact so much, huge way to Chinese people. For Pakistan, it is of course a big number, almost a quarter or 25% of the salary goes in getting a full tank of oil. Now, for us, I think it's definitely high sensitive point, because if an average person is paying 17% of his salary to get a tank of oil, and if prices goes even 10%, 20% higher, I think that cuts a lot of his savings. He won't have enough money to spend on buying things. That affects the consumption. That will affect the demand, and the sales of the company will get hit. So high price of oil is definitely not good for Indian economy, and let's hope that oil prices cool down in the coming months. The second chart which I'm going to show is about currency valuation. Now, because of high oil prices, because of the crisis, people are moving back to safe haven like US. The foreign investors normally they go back to US whenever there is a crisis, whenever there is a war. And FIs have been withdrawing. FIs have been withdrawing from India since October. It has been the sixth continuous month when FIs have been withdrawing. Now the question mark is, if the crisis goes for long, if the US hikes the interest rates, which currencies will fall? So let's look at this chart. Now this chart shows that which currencies are overvalued and undervalued. This is on the basis of data, of real estate, real exchange rate. Now this shows that India or the Indian rupee is overvalued by 15 to 20%, which is a lot. So if the crisis goes long, then we may see Indian rupee devaluing by 15-20%. But there are other countries whose currencies are also overvalued. If you look at the Chinese renminbi, even that is overvalued. The US, Canada, and the Australian dollars are also expensive. There are some countries whose currencies are undervalued, like Turkey, which is undervalued by 15-20%. Japan, yen is undervalued by 15-20%. So if you want to plan your holiday, maybe Japan or Turkey may be a good place to go to. But yes, if the crisis goes for long, the Indian economy may see some stress. The Indian INR will see some stress. Now the third chart which I am again going to talk is about oil. One more chart on oil because oil is a big factor for India, and how much it is going to impact us is very important. Now I have been talking to many people. I have been trying to understand according to them how long this crisis is going to go, and no one has a right answer. Everyone have different views. Now one indicator which I use a lot of time is the forward price of oil to understand what market is discounting about the future. There's a spot price and a forward price. Spot price tells you the current price of any commodity or any stock. The forward price tells you what is market expecting about that stock, maybe 1 year down the line, 2 year down the line. Now this chart shows 1 year forward price of the oil. Now, if you look at the forward price of oil in March 2020, it's trading at a discount of 25%, which means we are already talking about 1 year price down the line of 90. So market is discounting the information that the crisis is not going to go for long, and this is going to get resolved maybe in 1 or 2 quarters, and the oil prices are going to come down, which I think is a phenomenal news. As I showed you in the previous charts, Indian economy is dependent on oil, and if the data is saying that the crisis may not go long, then I think it's definitely good. So don't make your investments decision based on present data, because a lot of time market discounts the current information and it looks at the future. Now, if you remember in the time of COVID, when in the March when market tanked by 20-25%, everyone thought that the markets are going to crash further. But markets suddenly started going up from 21st March onwards because market knew that crisis is not going to last for long. And market started going up despite the COVID crisis continuing for long. So yes, what this chart clearly tells us is that the oil crisis is not going to stay long. The company's profits may be affected by 1 or 2 quarters, but in long term, it won't be affected. The earnings are going to be very good, the companies are going to do well, and stock markets are going to do well. Now, the fourth chart which I have is on the US interest rates. US interest rates have been coming down after the COVID. The US Fed had cut the rates to boost up the economy, to boost up the demand. The rates fell to 0%. Now, government of the US has been following a very relaxed policy. They have been pumping liquidity all over the world. And because of it, the stock market went up, because of which the demand came back. The economies are doing very well. Now, what has happened is that because of too much of liquidity, there has been an over demand and the supply of the goods has not been able to match. And because of which there has been a high inflation. The inflation in US has hit 7.9%, which is an all-time high. And because of high inflation, US has been saying, okay, I'm going to increase the interest rates to control the inflation. Normally, the government, the Fed increases the interest rates to control the inflation. And the talks have been going since October of 2021, and the Fed has been saying that I'm going to hike the rates. Few weeks back, it increased the rate by 0.25%, and it said that I'm going to hike 6 more times in this calendar year 2022. So, which means that the interest rates may go to around 2%. Now, the question mark is it relevant for us? How much is it going to impact the stock market? Yes, it's definitely very relevant, but what has happened is that market has already discounted this information. In this last 6 months, the 10-year GSEC or the interest rates in the US has gone up from 1.25% to 2.5%. So the news of interest rates going up this year may have already been discounted and market may not react to it negatively. Now, if you look at this chart, there are some important information. If you look at the US data, if we clearly look at the one which is blue highlighted, the CPI, which is an inflation indicator, is at 7.9. The central bank rate is 0.38. The real rates are negative. So investors are, net of inflation on their deposits are making minus 7.5%. So a 2% hike really doesn't cut the ice so much. So it's fine. Market is going to be fine about it. If you look at the Indian data, now Indian data we have the interest rates at 4% and the CPI at 6.1%. So inflation is around 6. The interest rates of the RBI at 4, which means that we have a negative real rate. So RBI is also going to catch up on the interest rates. They are going to hike the interest rates in 1 or 2 quarters, especially because globally the rates are going up and also the crude prices are high. I think interest rates going up is fine. It's good for the fixed income investors, especially senior citizens or conservative investors. You will see the interest rate on your deposits going up, which means you will have more savings in your hand to spend. And there are few economies which have positive interest rates, Russia, China, Indonesia, but these are outliers. And I think in next 1 year, you will see interest rates going up everywhere. So it will have some impact on the stock market, but it is fine. Won't have a huge impact. Normally, the stock markets, as per historical data, have done well when interest rates have gone up. And I think equity is a very good hedge against rising interest rates. So stay invested in the equities. Don't worry so much of the rising interest rates. Now the last chart which I have is on gold. Now in the previous chart I explained you why inflation is going up, and inflation is going up because of the commodity prices going up, because of the supply side issue and over demand. Now a question comes in everyone's mind, okay, if inflation is going to be high, then where should one be investing? And the first asset class which comes in the mind of the investors is gold. People think that since it's a physical asset, gold does well in the times of rising inflation. Now, in this chart, what I have done is I have taken the data of the gold from 1980 onwards, when it hit a all-time high, and since then I have plotted the gold data adjusted against inflation. So net of inflation, how the gold has done. Now, if you look at this, at 1980 the price was $837. Today it is trading at $636 after adjustment for inflation. So the real price of gold has not been able to even come back to the 1980 prices, which is not a great news for gold investors, and it clearly shows that gold is not a great hedge against inflation. Now it's also important to highlight the period between 2020 and 2022. Now, if you look at this period, gold has been almost flat despite inflation being all-time high. In US, the inflation is 7.5%. So technically, the gold prices should have gone up, but no, it has not been going up. So gold has its own headwinds, and gold has a very, very long cycle. If you're investing in gold, you may have to, you need a time horizon of maybe 15, 20 years. So if you don't have a time horizon of 15, 20 years, don't invest in gold. If you're the only reason if you should be investing is gold is if you're fond of gold. If you're fond of gold, then yes, that is fine. And even if you want to invest in gold, invest in sovereign gold bonds which are issued by RBI, because they give you additional 2.5% interest every year. Now gold can be a great investment if you're able to time it right. See, since 2002 the gold prices went up. Now it's very difficult to perfectly time it, but yes, if you're able to time it, then yes, you can make return. But if you look at this, after sharply going up, it also came down. So especially when you're investing in sectors, commodities, you have to time the market twice. One, your entry has to be right, and second, you have to exit at the right time, because if you don't exit at the right time, all the gains can go away. So be careful about investing in gold. So that was all from my side today, and I hope you found this interesting. Do share your feedback about my video, and I'll be definitely try to bring more information which is more relevant to your portfolio. You can stay in contact with me. You can reach out to me at the website of Alpha Capital, which is www.alphacapital.in, or you can send us a mail at contact@alphacapital.in. Hope you have great weeks ahead. Hope you make right investments decision. Take care, stay blessed. Thank you so much.